Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Chief Investment Officer, EMEA and Global Head of Equities. We're going to discuss some of the key themes driving markets. These include the growth outlook now that Donald Trump is President of the United States and the forthcoming European elections. So Mark, following Trump's election, markets appear to be more optimistic about the growth outlook. Is this justified?
As you say, markets are, equity markets trading at all-time highs, S&P making new highs every day, and is pretty optimistic about the outlook for corporate profits in North America. And we would say the answer to that question would be a qualified yes and no. So certainly the fiscal measures, where he's looking to spend money on infrastructure, defence and so on and so forth, would boost corporate profits. And the tax cuts that he's looking to introduce, reducing US corporation tax to make the US more competitive globally, would be positive for corporate profits. But the thing that's unusual, and the reason I say it's qualified, is that we've not seen in economic history before this level of boost to the economy coming at a time when we're at full employment, and we are nearly at full employment in North America. And the unemployment rate is trending down towards 4.5%. And classical economics would suggest that this level of boost to the economy would introduce some inflationary pressures into the US economy, and we're likely to see a Fed response to that in tightening interest rates. So that would slow growth. So that's one reason for being qualified. Secondly, the tax cuts at a personal level are likely to benefit unusually the wealthiest in society. They have historically not spent their gains when they've come through in this fashion. And then thirdly, the trade controls and the migration controls that was discussed in the run-up to the election, again would be negative for growth. So we think if you add all those three things up, at best, Trump's policies would be neutral for growth, but at worst could be negative for growth. So we think the markets may be being a bit optimistic about the outlook for growth given the plans that he's got.
So with all of that in mind, does this mean we need to reconsider our view on the outlook for global inflation?
As I said just now, we are clearly approaching full employment in North America, and I think we need to watch the implications of the fiscal measures very closely, because I think the Fed will tighten more aggressively if it sees inflation coming through. Although I think inflation is probably an acutely North American phenomena, if we give the US workforce some bargaining powers, they're likely to negotiate hard, and we could see some wage pressures coming through for the first time in many years, and that will start to push inflation through the US system.
If the Fed is more aggressive in raising interest rates, what does that mean for markets and the dollar specifically?
The dollar's been, in a bull trend. It's been going up against other world currencies for 3 or 4 years now on the expectation of tighter US monetary policy versus the rest of the world. And this would underpin that trend and would likely to lead to the dollar going higher from here. Historically, a strong dollar has not been good news for risk assets, and it's specifically not been good news for the emerging markets. So I think if we saw the dollar going up aggressively on the fact of tighter US monetary policy, that will probably introduce some uncertainty into the outlook for the emerging markets. If it rises gently, we can probably cope with that, but it's something we'll need to monitor very closely.
Shifting the focus to Europe, what should we be reading in the opinion polls regarding the forthcoming European elections?
Well, given the experience of both Brexit and Trump, I think the answer to that is we probably shouldn't reading too much into the opinion polls, because they have historically been not too accurate, certainly in the most recent past. But we've got some key elections coming up. We've got the Dutch election in the middle of March, we've got the French election in the middle of May, and we've got the German election in the second half of the year. And certainly the far-right party that's leading in the polls in Holland has got a manifesto commitment to take Holland out of the euro. And clearly the far-right party in France, Le Pen, has got a manifesto commitment to take France out of the euro, or Frexit as it's become known as. And both of those, if either of those things came to pass, that will place quite a lot of pressure, we think, on the European financial system. The banking sector still, in many places, needs more capital, and the prospects of a large constituency, particularly France leaving the euro, would be a really, really big deal for the European financial system, and will place some pressure on global markets more broadly, we think.
So any one of those events, that shift to the right towards populism, will lead to increased volatility in risk assets?
Yes, it would. Equity markets at near-term or all-time highs, bond markets relatively becalmed, currency volatility is quite low. Volatility more broadly is relatively low and could be placed under some pressure were we to see an unexpected outcome in the European elections.
Mark, thanks very much.